I'll tell you why exactly I feel the stock market is going to explode, when it's going to explode, and how you can take advantage of it. And by explosion, I don't mean like 10%, 15%, 20%. What I'm trying to say here is 30%, 50%, 100%, doubling the money. India's national deficit is going down. There's clear evidence that the private investment in projects and spending is increasing retirement funds to participate in equity. There is a whole new set of people who is going to come into the equity ecosystem, which is going to push the share prices upwards. So there is a 40-50% jump which would come over the next months. The jump is coming. Now the question arises, how do you play this? What do you do? Hi friends, so if you've seen the thumbnail and clicked on the video, then I'm sure you won't be disappointed. I'll tell you why exactly I feel the stock market is going to explode, when it's going to explode, and how you can take advantage of it. Before I start the video, I want to give out some data to you. So please listen to it very carefully, because if you miss this, you'll miss the entire point. So as you all know, there are two major indexes in the Indian stock market, which is the Nifty and the Sensex. And if you take the data of the last 15-20 years, the average returns of both these indexes have been close to 15%. What that essentially means is that your money doubles every 5 years if you invest today. For example, if you would have invested 1 crore in 2005, then it would have become 16 crores right now, that is 2025. But what's important to know here is that the market doesn't always move systematically or in a consistent way. You might see a period of 3-4 months, 6 months, or even a year where the market doesn't move much, and then there will be a sudden spike in the next 2 or 3 months, which will actually cover for the last 2 years or 1 year or whatever that period is. So the market never moves in a systematic way. By the end of the video, you'll exactly know why I'm giving out this information. So what are those factors which are going to cause the explosion in the stock market? And by explosion, I don't mean like 10%, 15%, 20%. What I'm trying to say here is 30%, 50%, 100%, doubling the money. That kind of an explosion. And if I were to take a specific time frame, let's take it the next 6 months to 18 months. And let's find out the factors that are going to cause this. India's national deficit is going down. What does national deficit mean, first of all? National deficit means the government's earnings versus the government spending, the difference between the two. So when the government spends more than it earns, that is basically creating a deficit. Now the deficit was there, but now it's going down. And what's the reason for this? So basically up till now, the government was funding most of the projects, and government wanted the private investment and private players to come inside and fund these projects so that the government spending decreases, so that the pressure on the government or the burden on the government decreases. Now how that's happening? Because the government is building new roads, new ports, new infrastructure, because of which the confidence of these private players is increasing. And that's why they are spending more and more. And let me not just say this in words. Let me back this up by data. In 2019, there was a figure of -4.2% was the growth rate of these private spending coming in. That means it was negative. It was actually decreasing. This was in 2019. Compare that with December 2023. The growth rate is 16.9%. So that means there's clear evidence that the private investment in projects and spending is increasing, because of which the government spending is reducing, and so the national deficit is going down. And so because of this, in the next 3 years, India's economy from a deficit economy is going to go into a balanced economy. And when that happens, the growth is basically outpacing the interest rates. And when the interest rates go down, usually the share prices go up, because people tend to put their money into equity. The second reason is that the government's allowing of retirement funds to participate in equity. So a few years back, our government passed a law that the state retirement funds can invest directly in equity. So a lot of money came into equity, and it's still coming in. To give you an example, in 1980s, the US passed a similar law where these employee funds could invest in equity. And for the next 20 years, there was a big boom in the US stock market. Now compare that to the Indian stock market. Here, the boom could last even longer than 20 years because the population of our country is very young. Another reason is rising social equity. Now let's understand this very carefully. Over the years, the brunt of price swings was mostly borne by the poor. And now that's slowly changing because of the efforts taken by the central bank to decrease inflation, along with the declining rates of female feticide. Upward mobility of the poorest class is increased. Now combine that with India's forecast of 6.8% of growth of GDP. These factors together are going to decrease poverty, increase employment worker class, and put people in a much better position than they were. So when this happens, is people tend to invest. There is a whole new set of people who is going to come into the equity ecosystem, which is going to push the share prices or the stock market upwards. Another very important reason is the burgeoning ecosystem of startups, especially addressing deep tech and agriculture needs. Competition among Indian states and cities to be innovation and investment hubs, and a leading boom driven by digital credit enabling system, which is going to bring millions of people under the financial net, giving them access to finance. And what happens when you give them access to finance? They tend to spend, they tend to invest, and a whole bunch of new people, along with new funds, are going to come into the equity ecosystem, which obviously helps the share market. And one more reason is the private consumption. Now, this could be confused with the rising social equity, but this needs to be explained separately. So the private consumption is increasing, and when I say increasing, it's increasing in every way. Now there are like aspirational spending and things like those. So there is more spending in luxury products. So when you see compared to before, people are wanting to lead a better life. People are wanting to invest and buy better products. So when that happens, ultimately businesses tend to flourish. One more thing that happens along with it that you're no longer dependent on exports. When any country's private consumption is increasing, your dependency on other factors decreases quite a lot. So basically, there is a whole cycle that starts. People spend, companies do better, they post better results, they make money, the shareholders make money, and they again spend. The last reason, which according to me is the most important reason, is that the historical returns of the Indian stock market. Now, if you're not a fundamental person like me, basically, don't get me wrong, I look at the charts and I see what the data tells me and I shut off all the noise. That's what happens a lot of times to me. And if you are that person, then forget all the things that I mentioned before this and just understand one thing, that the point that I gave you in the beginning, that the returns of the last 15-20 years of the Indian stock market have been 15% CAGR. That's compounded annual growth rate. What I'm trying to say here is that because the returns of the last 2 years have been nothing, and the average returns of the last 15-20 years has been 15%, this average has to catch up somewhere, because it's telling you that whatever you do, come what may, how much ever noise you make, the long-term returns of our stock market comes back to 15%. Now at this point, a lot of other people will compare the stock exchanges of China and Japan and say that for years there were no returns. And see, my point is that you do not compare another country with in a country like India, because everyone's growth story is different. Why India is different and why the Indian stock market is giving good returns or is going to give good returns is because we are a growing economy. There is so much potential. And with China, probably the potential was only this much when the stock market wasn't giving returns. Compare that to someone who's standing on the 45th floor of a 50-story building. Now, how many more floors can he climb? It's just 5 more floors, right? But if you're on the 10th floor, you have 40 more floors to go, and you can go at a really fast pace if you know the direction. And with India, that's what is happening. The growth rate is really fast, and there is a lot of more potential. The saturation is going to come much later when you reach a position like China. Indian stock market should be treated exclusively and not be compared. And so what I'm saying is the long-term returns are going to come back to 15%. So now that 2 years there have been no returns, so you are talking about a 30-32% returns, which is pending, and another 15%, 12% returns of this year. So there is a 40-50% jump which would come over the next 6 to 18 months, because if it goes beyond the year, then you add another 12 to 15% of that year, which is supposed to be accumulated. So the more time goes, the closer you are to that jump that's going to come in. Now, whether that jump comes in like 1 or 2 big jumps or like 5 big jumps, I don't know that, but the jump is surely coming. Now the question arises, how do you play this? What do you do? When I say what do you do, firstly, let's understand this. There must be 2 kinds of people watching this video. One who's already invested in the stock market heavily or moderately, and the other one is who's either not invested at all or a light investor. So I'm going to address both of these separately. So when we talk about the one who's not invested much in the stock market, what do you do now? So my advice is that there couldn't be a better time to start with, since I already told you there is a jump coming in. So you might not see a long phase of no returns, which can happen with many people, and then they get frustrated with the stock market. You have this opportunity now. So you open your Demat account, and if you've already opened a Demat account, then I think you must be expecting me to tell you some names of the stocks which you can invest in, but I want to disappoint you here. I feel stock picking is the most overrated thing in investment. The most underrated thing in investment is staying invested, and I'm going to talk about that now. Now, if you want to know exactly what to invest in, if you're confused, do not waste your time in trying to pick a stock. Just go for mutual funds. And I'm not promoting any particular mutual funds. Why I'm suggesting mutual funds, any good mutual funds, there could be HDFC, Axis, Kotak Blue Chip, or whatever it is. Just stay invested. If you want a large cap fund, take a large cap fund. If you want a mid cap, small cap, whatever you want to do, or take a mix of these three. You can go to any of these websites. Just type on Google, mutual funds returns last 5 years, 10 years. You'll get many websites. Will give you the historical returns of mutual funds. Whatever you can understand, whatever data you can understand, just go through it. All of these mutual funds are managed by really experienced fund managers. So there is not much risk there, and these are all really big funds, like managing thousands of crores. So what makes you think by picking a stock you are going to be smarter than that fund manager? He's sitting there with a lot of data with a team. So you trust him with that job. Just invest, do a monthly SIP. That's the best way to do it. You are entering at like average, whether the market is low, whether it's high, you're getting an average price, you're getting an average entry every month. So you are like balanced in a way. Every time you get a big chunk of money, whether it's a business income or a salary, just put that chunk in there. If you want to put, as I said, a systematic way of doing it is monthly. If you have some part of your profits from your business or some part of your salary which you want to invest, just do an automatic SIP there. Okay. The second kind of people would be the ones who are already invested. Probably they know a lot more than me or as much as me. So my suggestion would be just to stay invested. You can double down on your investment. Now is the time. If you have a chunk of money by a sale of some property or something else, just if you're happy with the returns your portfolio has generated over the last 5 years, 10 years, don't even look at 5 years. Look at 10 years. 5 years period can be deceiving. Look at your last 10 years returns. If you're happy with it, just increase your investment. Just put in a big chunk of money or just double your monthly SIPs for now. I think that's the best way to play it. The biggest things in life, the most important things in life are rather simple. Stock picking and trying to find that secret stock which gives you 10x, 100x returns. Let me burst that bubble. No big person has made money like that. Consistently staying invested, capitalizing on one or two or three opportunities that come your way is the way to go. There are even people who have just made money by investing and trading in just one stock, because it's just fancy to look at so many things, but ultimately the money that you earn from any stock is the same, whether you've made it from 50 stocks, 500 stocks, 5 stocks, or just one stock. So keep your focus on social conversations. I know are important, so it's good to have knowledge of multiple stocks, of knowing their fundamentals, and boasting about it, and discussing things. But that's only for discussion purposes, right? When you're focused on making money, there's only so much that is required. Also, as usual, let me know if you've liked the video. Please like it and subscribe to my channel. And yeah, keep watching. Thank you.